All right. One key thing you need to understand is that when you are solving question under capital budgeting, for example, examiner can ask you to calculate net present value, internal rate of return, modified internal rate of return, project duration, all right, discounted payback period, or adjusted present value. Any of the discounted cash flow techniques, all right? So the most important thing you need to do is to identify relevant cash flow from the question. Remember, when I was discussing with you last time, I mentioned that there are three criteria or factors or determinants or basic requirements for project evaluation. Anytime you want to evaluate a project, there are three key requirements that must be present. If any of those variables is not available, it will be difficult to ascertain financial viability of a project. The first one is relevant cash flow. All right, the cash flow to be used for project evaluation must be relevant and consistent with the cash flow and the project risk. Okay, all right. The second one is appropriate cost of capital. All right, the cost of capital must be suitable. All right, with the cash flow as well as the project risk, the risk associated with the project. And the last one is useful life. Without useful life, it will be almost impossible to ascertain financial viability of a project. Therefore, when you are given a question, all right, when you are given a question, an examiner is asking you to evaluate the project and advise whether it is financially viable. What the examiner is simply asking you to do is to calculate net present value. Okay? At times, examiner can say that you should determine financial viability, or examiner can ask you to advise whether the project should be undertaken. In any of the, whatever the requirement, once you discover that this question relates to capital budgeting, and you are not told the technique to use to evaluate the project, then it has to be net present value. Why? Because net present value is a technique that is consistent with the shareholders' wealth maximization objective. All right. And that's what I told you last time, that NPV is adjudged. NPV is considered to be the overall investment appraisal technique because a positive NPV will increase the value of the company and which will invariably maximize the shareholders' equity value. And that is why NPV in theory, okay, that's why NPV is considered to be the best or to be the overall investment appraiser technique. Okay, therefore, when you are given a question, first thing first, you have to identify relevant cash flow. You are going to scan through the question from A to Z. So first thing first, you start from the requirements. From the requirement, you'll be able to deduce what are you supposed to do here. At times, examiner may be very magnanimous, telling you, showing you directly what you should do. Like for example, in this number B requirements, right? You have to compute net present value and modified internal rate of return. This is, examiner is specific here, right? Therefore, I want to calculate NPV. What am I supposed to do? I know for me to calculate NPV, I need relevant cash flow. I need appropriate cost of capital. I also need a useful life of the project. All of that, I will look for the question. I will look inside the question and go and identify it. All right. So that's what you need to do. However, at this level, anytime you are given a question, you have to start. Don't start with the body of the question. You need to first of all understand the requirements. Okay, so you then go to, for example, requirement number A. Jade Yemo, thank you. Well done. Oluwatosin, well done. So the first thing you are going to do is to go to the requirements. Go and check what is examiner asking me to do in this question. When you look at requirement number A, you have to compute appropriate cost of capital that Telemundo PLC should use to appraise the cement project, and state why you consider this rate more appropriate than the existing WACC of 11%. So examiner is asking me to calculate WACC. All right. Notes: your final cost of capital should be rounded up to the nearest whole number. State any assumption made. All right. So the reason why examiner is specific in this question is that they want everybody to arrive at the same answer. That's why examiner is telling you that you should round your number to the nearest, round your figure to the nearest whole number. So if you do otherwise, you may be penalized. Okay. Now, you want to calculate appropriate cost of capital. You then need to ask yourself, what kind of cost of capital? Is it traditional weighted average cost of capital? Is it project-specific cost of capital or WACOCA? All right. The information given in the question or the direction of the question will tell you which one you are expected to calculate. So let's start with the A requirement. I want to calculate appropriate cost of capital. I know for sure if I'm using traditional model, I must have information about capital structure, right? I'm going to be given ordinary share capital, preference share capital, debt capital. I will have dividend in the question. I will also have interest in the question. All right. So if I don't have any of those, that means I cannot calculate traditional WACC. Okay. I will also go to the question and identify. We said that under project specific is estimated when a company is diversifying. When a company is moving from one industry to another industry, then the current WACC of the company will not be suitable. Therefore, a cost of capital that will be consistent with the systematic business and financial risk in the new industry, with the project will need to be estimated. So I will go to the question and identify if the company is diversifying. If the company is not diversifying, then it has to be the third one. The third one says that, which is WACOCA, weighted average cost of capital of the combined activity. And we said that WACOCA is estimated when a company is engaged in different business activities almost at the same time. So instead of using different cost of capital to evaluate each of the projects, all right, to evaluate projects in each of the activity. Therefore, a singular cost of capital that will be suitable to appraise all the projects to appraise project in any of the activity will need to be estimated. So this is what is known as WACOCA. Therefore, let's now dive into the question. Let's read through and identify which of them are we going to calculate. All right. So I need one of you to read for us. Who is helping us to read quickly? Yes, who is helping us? Yes, I need a CNN. Yeah, thank you. Go ahead.
Company list on Nigeria.
No, Ida is reading. Ida, go ahead.
Telemundo PLC is a company listed on the Nigeria Stock Exchange. It is involved in property development and sales. The company currently imports more than 60% of its cement requirements. At a recent meeting of the board of directors, the decision was taken to establish a division to produce cement in Ore, Ondo State. If the division is set up and the cement production goes ahead, output from the division would be sold to Telemundo PLC. Telemundo PLC and external customers at market price. For planning purposes, it has been decided that the financial viability of the project over the next 5 years should be determined. The sum of 2 billion naira will be required. The sum of 500 million will be spent to acquire an existing factory considered suitable for the project. The balance of 1.5 billion will be applied for the procurement and installment plants, and tax allowance can be claimed on plant and equipment at a uniform amount over 5 years with nil scrap value. A total of 20 million has been spent on various surveys, markets, technical, financial, etc. To date, out of which 10 million naira has been paid. The balance of 10 million naira is due for payment at the end of year 1. Production of cement for the next 5 years is projected as follows. All figures are assumed to be correct. A bag of cement sells currently for 2,000 naira in the open market. The price is expected to increase at the rate of 5% per annum. The variable cost is now 800 naira per bag. This will increase at 4% per annum. Fixed overhead cost will be 50 million at current prices, but will rise by 8% per annum. Apportioned head charges of 25 million at current prices will rise by 10% per annum. 50% of the total initial outlay of 2 billion naira is to be funded with a loan from a federal government development bank at a concessional fixed interest rate of 8%, payable at the end of year 5. The project will require a working capital of 10% of annual revenue, and this should be available at the beginning of each year. So please scroll down. The company uses a current weighted average cost of capital of 11% to appraise all capital projects. The asset beta of the company is 1.2. Beta is 1.0. Rate is why the market rate premium is 7. The is of the view that it is not appropriate to appraise. He has identified a listed company which produces a
I don't know if it's from my side. I can't hear you clearly, either.
I think it's a network.
Okay. So either you can hold on. Let me take it over from there. All right. You can hold on. So you can then mute yourself. Mute. The finance director is of the view that it is not appropriate to use the existing WACC to appraise the new project. He has identified a listed company which currently produces cement and packaged food drinks. All right. So the finance director has identified a listed company. That must be a proxy company. All right. The company has the following financial statistics: equity beta 1.82, debt 0.40, debt to equity ratio 40%. So this debt must be debt beta. All right, that's debt beta. Okay. 60% of the market value of the company is attributed to cement production, while 40% of the value is attributable or is attributed to the food drinks division. The food drinks division has an equity beta of 0.8. The new project is expected to move Telemundo PLC to the target debt equity ratio of 30%. The tax rate is 25% for the two companies and is paid in the year profit is made. So that is the question. This is the story given to us in the question. You are now asked to compute appropriate cost of capital. So based on the information given to you, which cost of capital do you think we are expected to calculate? Is it traditional WACC? Is it project-specific WACC? Or is it WACOCA? All right. So in this case, because in the question, we are told that Telemundo PLC is a listed company on the Nigerian Stock Exchange. The company is involved in property development and sales. What this company does is property development and sales. You construct house, then you sell it. All right. However, we are told that at a recent meeting of the board of directors, a decision was taken to establish a division to produce cement in Ondo State. All right. So this company is into property development and sales. The company is now diversifying into production of cement. The company usually buy its cement, 60% of its cement production, consumption from abroad. Okay, but now the company is contemplating to establish a division in Ore to produce cement. So it means that the company is diversifying. So if the company is diversifying, and in the question examiner is asking you to calculate appropriate cost of capital, then this has to be project-specific cost of capital. What we are going to calculate is project-specific cost of capital. So how do you then calculate project-specific cost of capital? We said that to estimate project-specific cost of capital, there are 5 steps you are supposed to carry out. The first step is to identify the proxy beta. Okay. Step 2, you ungear the beta if it is geared. Step 3, you regear to incorporate the financial risk of Telemundo. Step 4, you calculate cost of equity using capital as a pricing model. Then step 5, you calculate project-specific WACC. It's as simple as that. No matter how big is the question, is the same procedure. Once you identify that the company is diversifying or the company is moving from one industry to another industry, the existing work of the company will not be suitable to appraise a project in the new industry. Therefore, a cost of capital that will be suitable and consistent with the project risk will need to be estimated. This is what is known as project-specific work. So quickly, without wasting time, let's estimate WACC. The name of the company is Telemundo PLC. What are we asked to do? We want to calculate project-specific WACC. All right, I will then say calculating projects specific cost of capital. I'll simply say project specific WACC. And we said that to calculate project specific WACC, there are 5 steps you are supposed to carry out. The first step is to identify the proxy beta. Let me just go to our previous explanation. Oh, okay, this is not cost of capital. I wanted to pick the formula we have used before so that it will be faster. Let me see. Let me see if I can. I don't need to be looking for formula again. I can just pick it somewhere. Let me 1 minute. Okay, almost there. I'm trying to copy the formula we have used before so that it will be faster from this one. This is not what I'm looking for. Coming. Where are you? Where are you? Oh, let me go to Sorry, 1 minute. Let me just open. That's study material, SFM, working notes. Which class is that? That should be class number 6 or 5. So number 6. Okay. Hold on for me. I'm almost there. Okay, then. I want to copy all the 5 procedures instead of me to be writing it afresh. So let me just copy it. All right. Now I have it. Okay. So, sorry for the break in transmission. So, like I said, to calculate project-specific work, there are 5 steps you are supposed to carry out. The first step is to identify the proxy beta. There is no need for you to say identify the proxy beta, just say proxy beta. All right. So I will then go to the question, what is the proxy beta given to us? Let's go back to the question. You just go straight to where you have information about the proxy company. So we are told that the finance director is of the view that it is not appropriate to use the existing work to appraise the new project. He has identified a listed company which currently produces cement and packaged fruit drinks. Remember, what you are looking for is the beta of cement, all right, because Telemundo is diversifying into production of cement. So you have to look for beta of cement industry, okay? But the company that we have identified produces cement and packaged fruit drinks. That means this proxy company has 2 different activities. The proxy company has 2 different activities, cement as well as packaged fruit drinks. So that means whatever beta we get for this proxy company will then be a combined beta. All right, it will be a combined beta because that beta will be for cement as well as packaged fruit drinks. So you are now told that the company has the following financial statistics. So we are given equity beta of 1.2. So since this proxy company is into production of cement and packaged fruit drinks, it means that this 1.82 is a combined equity beta. It is meant for cement and also packaged fruit drinks. So we are not given in this question, we are not given equity beta of cement. We are given combined equity beta of 1.82. We are also given equity beta of packaged fruit drinks. Okay, we are given equity beta of packaged fruit drinks to be 0.8, but we are not given the beta of cement. All right, so since we are not given beta of cement, then we need to find a way to get the number. All of you that are making noise at the background, you are looking for my trouble. Stop it. Ovie, Ayomide, Mary, mute yourself. Mary, mute yourself.
I was muted.
All right. So, because the proxy company does not have beta of cement, had it been the proxy company has beta of cement, life would have been very easy. And that is what examiner has hidden in this question. You can see requirement number A is for 12 marks. Requirement number A is for 12 marks. That means you have to sweat. So if you are unable to determine the beta of cement, there is no way you'll be able to solve the question appropriately. So the proxy company is into cement and packaged food drinks, and we are given a combined equity beta of 1.82. Therefore, I will then come here, proxy beta of cement. I'm looking for proxy beta of cement. All right. Let me comment on that. The beta of cement, the beta of cement Who is that person making noise in my class? Who is the person?
It's Augustine.
Augustine. Augustine, if you repeat that next time, I will remove you from the class. If you make noise in my class, I will remove you.
I'm not sure he can hear you because he's still not muted.
I'm not even seeing him here. If I'm seen on the list, I will just remove him straight because I don't want any disruption. No worries. So, in the question, we are not given the beta of cement. Since we are not given the beta of cement, in that case, we need to find a way to calculate it. So I would then say the beta of cement is not given. I'm writing this because of you so that you understand why we are doing it the way we are doing it. Therefore, the available information or the proxy, the available financial statistics of the proxy company will be used to identify the beta of cement. This is shown as follows. So this is what you're supposed to do. I will then come here. According to the question, right? According to the question, you are given equity beta. We are given equity beta of 1.82. This equity beta is a combined equity beta. This is a combined equity beta. Let me write it down. You are given combined equity beta. Okay. Let me copy this. I like to use that. Okay. So we are given combined equity beta of 1.82. This 1.82 is meant for cement and fruit drinks. This is for cement and fruit drinks. Okay. Next, we're also given equity beta. We are given equity beta of fruit drinks. Okay, equity beta of fruit drinks to be equal to 0.8. According to the question, equity beta of the fruit drinks, we are told that the fruit drinks division has an equity beta of 0.8. Okay, Not only that, in the question, we're also given debt beta of 0.4. All right, we are given debt equity proportion of 40%. So I will come here. The proxy company also has the proxy company has debt beta of 0.4. You are given debt equity proportion, okay? Debt equity ratio. All right, the debt equity ratio, that's the gearing ratio, D to E, to be equal to 40%. All right, so if debt is 40%, it means that equity will be 60%. So D is equal to 0.4, or let's say just 40. All right, while equity is equal to 60%. All right, let me just put percentage. That's the gearing ratio we're expected to use. We also given market value. In the question, examiner give us market value of cement to be equal to 60%. I think, let me confirm that. Yes, you are told that 60% of the market value of the company is attributed to cement production, while 40% of the value is attributed to food drinks. So market value of market value of cement is 60%. Here is 60%. It's the same thing as 0.60. Market value of fruit drinks is equal to 40%, which is the same thing as 0.40. So this is the information of the proxy company given to you. All right, so let me just put it down. Proxy information. Okay, so this is information about the proxy company as given in the question. Let me just put the bullet points. All right, so in this case, life has been so easy. I don't need to be sweating over this. I already know that I'm not given the proxy beta of cement. So because I'm not given proxy beta of cement, I've identified from the question that this processing company is into cement and fruit drinks, and the beta of the company is 1.82. So we're also given, you have three variables. Number one is combined beta. The second one is the beta of cement. The third one is beta of fruit drinks. So you are given beta of fruit drinks. You are not given beta of cement. You are also given beta of you are given combined betas. You need three variables. Out of three variables, you are only given two. So you can use the known variable to get the unknown variable. All right. So in this case, I would then say beta of cement. I want to calculate beta of cement. Calculating beta of cement. That's what you are looking for. You don't have it in the question. That's why we are going through all of this stress. Now, you will recall when we had when we had Wakoka, right? When we had Wakoka, step 4 of Wakoka is to calculate weighted average asset beta. The formula that you use to calculate weighted average asset beta of the combined, then it's that same formula you are going to use to identify the beta of cement. Okay, so let me just copy. Let me copy this. So I will then come here. Let me put it down for you. The formula for calculating weighted average asset beta will be used to estimate the combined, also will be used to estimate the beta of cement as shown below. All right. So I will then come here, beta of cement. All right. You have combined equity beta equal to, we have beta equity of cement. Let me use the beta sign to do this. Let me just copy it from here. All right. Okay, so beta equity of cement multiplied by market value of cement. According to the question, we are told that market value of cement is 60%. So that will be 60. Here will be 0.6. Before that, let me just use the formula let me write out the formula first. So total market value of cement, in this case, let me just, of cement divided by total market value of cement and fruits. Okay, this will be on the left side. Then on the other side, let me copy this. Plus, you remember this formula now. So beta equity of fruits. Beta equity of fruits multiplied by total market value of equity and debt of fruits divided by total market value of equity and debts of cement and fruit drinks. So this is the combined, this is the weighted average asset beta formula, or combined asset beta formula. All right. So because in the question we are given a beta of 1.2, 1.82, and that 1.82 is meant for both cement and packaged fruit drinks, and that's why you have to shine your eye. You have to know what you are doing before you put your pen to paper. Don't just rush to solving a question. So this combined equity beta of fruit drinks and package and the cements, according to the question, we are given as 1.82. This is 1.82. Beta equity of cement is not given in the question. That's what we are looking for. And you are told that the market value of cement is 60%. That means the cement is 0.6. There's no need for me to come and be doing the 60 over 100. Just put 0.60. That's the market value of cement. Then the beta of packaged fruit drinks, according to the question, is 0.8. You then multiply with the market value. Market value of packaged fruit drinks is 40%. So here will be 0.4. All right, that's it. At this point, I would then say 1.82 equal to 0.60 BC. All right. Get out. Let me copy. Okay, so 0.60 multiplied by beta equity of cement, then plus 0.8 multiplied by 0.4 will give us 0.32. So the next thing I need to do is to collect like terms. I need to collect like terms. Therefore, 0.60 beta equity of cement will then be equal to, let me remove slants. All right, so 1.82, we go to the other side. So 1.82 minus 0.32. Therefore, beta equity of cement will then be equal to 1.82 minus 0.32. What do you have there? That should be 1. What? That should be 1.50. 1.50. All right. So divided by, let me use this one. Let me just copy this one. So here will be 1.50, then divided by 0.60. 0.60. So what do we have?
2.5.
Pardon? 2.5. Okay. So that means the beta of cement is 2.5. Beta of cement is 2. No, it can't be 2.5.
Yeah, it's 2.5, so
2.5. If the beta of the combine is 1.82, I don't understand. If combined equity beta is 1.82, beta of cement cannot be 2.5. The beta of cement cannot be more than the combined beta. So what is wrong? Let me see. 1 point. Okay, I think you are correct. Let me see. Let me use my cap.
Is 0.08 plus 0.8?
Pardon?
For the beta of fruit, I think it's 0.08 plus 0.8.
Is 0.8. See it there. Beta of fruit is 0.8. Yeah. So
I think we are right. It's the same thing we get in the Golden Book.
So no, what I'm saying is that the beta of fruits is 0.08, is 0.8, which is when by the time you multiply this, you give it 0.32. It's what it is. So it's 2.5. Let's move on. Okay, let's move on. Now, this is what the examiner has hidden in the question, right? This is what the examiner has hidden in the question. So, and that's why you are seeing that you are given you are awarded 12 marks to solve this particular question. Now, you have identified the proxy beta of cement to be 2.5. So that's your step 1. Step 2 now says you should ungear. All right. So let me call this one step 1. This is step 1. Then step 2, you need to ungear. You ungear to remove the financial risk. First thing first, you need to confirm this 2.5, this beta of cement, is it geared or ungeared? So according to the question, you are given debt equity proportion of the proxy company, all right, to be 40%. So since you are given debt equity proportion, you are given gearing ratio, that means there is debt. That means the proxy company has debt in its capital structure. Therefore, this 2.5 is a gear beta. If it's a gear beta, then you need to ungear it. Okay. Ungear the beta in step 1. All right. Let me flash it up for you. Get out. Let me flash it for you. Since the proxy company has debt or has gearing ratio, of 40%, it means the beta in step 1 is geared. So if it is geared, then you need to ungear it. All right. Therefore, the beta will be, no, before that, also a debt beta of 0.4 is given for the proxy company. Therefore, the formula below, all right, the formula below will be used to ungear. Therefore, the formula below will be used to ungear. All right, so that is that. Okay. So which formula are we going to use? I gave you 2 different formulas to ungear. So let me see. This is the one we are going to use. Let me just copy that. Okay. So I will then come here. I already have all relevant information in the question. The beta assets is what we want to, the 2.5 is geared because the proxy company has debt in its capital structure. We are given gearing ratio. Therefore, we need to ungear it. I would then say 2.5 multiplied by equity value, the debt equity ratio. We are given debt equity ratio of 40% for the proxy company. So if debt is 40%, equity will be 60%. According to the question, the examiner did not define the gearing ratio. Therefore, you are at a liberty to either use single value or total value. All right, single value simply means debt divided by equity. So in this case, debt is 40%, equity will be 60%. If an examiner define it, at times examiner can define this gearing ratio that you should use gearing ratio of debt divided by debt plus equity. So if that is the case, debt will be 40, equity will be 40 plus 60, that is 40 to 100. But in this question, the examiner did not define it. Therefore, I will just use 40 to 60. So equity is 60 divided by 60 plus 40. Then I will go back to the question. What's the company tax rate? What's the company tax rate according to the question?
25%.
So we are given tax rates of 25% for the 2 companies. You have to be very careful. At times, examiner will give you different tax rates. So you have to be very, very careful, ensure that you are using the correct figure. So we are told that a tax rate of 25% is applicable for the 2 companies, both the proxy company and then Telemundo. All right, so I will then come here. So 1 minus 25% will give us 75%, 0.75. Okay, then in the question, we are given debt beta. We are given debt beta to be equal to 0.4. All right. So debt value is 40%. Debt value is 40%. 1 minus tax rates, that's 0.75. Then equity value is 60 plus debt value 40. 1 minus tax, 0.75. Give me from the left. What do you have there?
1.60.
Okay. Vital assets. Let me copy this. Asset beta equal to, you said 1 point what?
67.
67. Then plus the one on the right. What do you have there?
0.13.
0.13. So when you add the two together, our asset beta will then be equal to 1.8. 1.80. That is the asset beta. All right. This is the asset beta that measures the cement industry. Now that we have the on-gear beta, we then need to re-gear to incorporate the financial risk of Telemundo. All right. We need to re-gear to incorporate the financial risk of Telemundo.
Sir, please, I have
Step
a
3.
question.
Who is speaking? I've told you
Kimberly.
if you want to speak to me, always raise your hand. Don't disrupt me. Yeah, go ahead. Go ahead.
Sorry, you said what you explained about the debt beta, that if they don't specify that you use single, I didn't really get that part.
I said that in the theories of gearing, there are different ways you can calculate your gearing ratio. I explained this in class also. I said that you can use single value or you use total value. When you say single value, this is what I'm trying to say. Debt to gearing ratio, if you are given, for example, like in this case, you are given gearing ratio of 40%, right? If you are using single value, according to, in the theories of gearing, let me just copy this. In the theories of gearing, you can say gearing ratio is equal to, all right, gearing ratio is equal to debt divided by equity. I've explained this before while I was taking you the notes. This, by now I would have moved to the next one. So debt to, this is one formula for calculating gearing. Here is debt to equity ratio. So in this case, I can say debt is equal to 40, then equity is equal to 60. This means I'm using a single value method, debt over equity. But if I want to use total value, right? If I want to use total value to calculate my gearing, right? I would then say gearing ratio equal to debt all over debt plus equity. So this means I'm using total. So in this case, if my gearing ratio is 40%, if this my gearing ratio is 40%, right? Then of course, D will then be equal to 40. Then equity will be equal to 40 plus 60. 40 plus 60. That means equity will be equal to 100. So in this case, my debt equity proportion, all right, my debt equity proportion will then be equal to 40 to 100. So I will be using 40 for debt. I will be using 100 for equity. So that means I'm using total value. If I'm using single value, this should be the value, my value of equity, all right? The value of the debt will be equal to 40, equity will be equal to 60. This is the gearing ratio. So, but if in the question the examiner did not define it, this one is faster and more straightforward. Just pick debt over equity, move on from there. But if at times examiner will define your gearing ratio for you, that you should assume total debt over total debt plus equity. So when if that is the case, if examiner define your gearing for you, that is what you are going to use. But if examiner is silent, you are at a liberty to either use the single value or you use the total value. Whichever one you use, you are good. Hope that is clear, Kimberly.
Yes, it is. Thank you.
You are welcome. So this is not part of this is just for explanation. It's not part of our solution. All right. Let me just put it there for example, so that you don't think it's part of our calculation. Okay. So step 3 says we should regear to incorporate the financial risk. All right. So to do this, the financial risk of Telemundo. Okay. So to do this, I will go back to the question and check if I'm given. Alex, talk to me. What's your question? Sorry, you've been raising hand for a while.
Sir,
Alex.
okay, good morning, sir. So I have an issue with this particular the beta of cement that we calculated, the beta equity of cement that we calculated, that is 2.5. While we have the combined distinct beta for fruit and cement for 1.8. So because looking at it from the perspective of the debt beta, where we have 40%, I will just impliedly state that the beta for equity is 60%. I was expecting something similar, but how did you come about the fact that our debt equity for cement is bigger than the combined debt
It
equity?
is formula now, so it's what it is. It is possible. One of them may be negative. So by the time you combine it together, it will reduce. So it happens. All right. It's what it is. It is formula. Yeah. Yeah, it is correct. The 2.5 is correct. Yeah. Yes. Who is that person again? Majolagbe, or what's the name? Somebody just raised hand. Okay, let me just. Mr. Austin, you are the one making noise in my class the other time. Please don't repeat it again. All right. So always mute yourself. Next one. Now we want to regear. Ifeanyi, you are the last person I will attempt to, so that we need to move faster. No time. Talk to me now.
Okay, sir. Good morning, sir. So the value of equity that you use in step 2, that you got 60%, is it the value of equity for the combined company?
Examiner has given to you in the question that it's not value of equity. Examiner has given to you the market value. According to the question, you are told the market value of cement is 60%. The cement market value is 60%. The market value of fruit drinks is 40%. So that's 60 plus 40, that will give you 100%. Okay? So market value of cement is 60. Market value of food drinks is 40%. So it is given in the question. All right? Fine.
Okay, sir.
Hello, okay then. So let's move on. So we want to regear. I will then go to the question and check for the information given about Telemundo. Are we given debt beta? All right. I'm going to check from A to Z of the question if I'm given debt beta of Telemundo. In the question, we don't have debt beta for Telemundo. That means it is assumed to be risk-free. So since you are not given debt beta of Telemundo, you are going to assume it is risk-free. Okay? So I will come here. The debt beta of Telemundo is not given. Therefore, it is assumed to be risk-free. It is assumed to be risk-free. All right. So if that is the case, this is the formula we are going to use to regear. All right. So to regear, beta asset of a gear is calculated as beta equity of a gear is calculated as beta assets multiplied by 1 plus 1 minus stars multiplied by debt equity proportion of Telemundo. All right. So if that is the case, I will then come here. Let me just copy the formula. But if you are given beta of Telemundo, you already know what to do. We have solved it when we are doing project specific. So the beta asset of Telemundo, sorry, of a proxy company is 1.8. That's what we calculated, 1.8. So here will be 1.8 multiplied by 1 plus tax rates is 25%. Then we are supposed to account for, you are supposed to account for 75%. I need debt equity proportion of Telemundo. I will go back to the question. What is the debt equity proportion of Telemundo? According to the question, you are told that the new project is expected to move Telemundo to the target debt to equity ratio of 30%. So debt equity proportion is 30% for Telemundo, which means that debt is 30%, equity is 70% for Telemundo. So I will then come here, debt is 30, equity is 70. If in your own case, you want to use total value, right? If in your own case, you want to use total value, then in that case, debt will be 30, equity will be 30 plus 70, which is 100. So you're going to use 30 over 100. But in my own case, I'm using, since examiner did not define it, I'm using a single value, that is debt over equity. So what do you have in your calculator? What's the final answer? 30 over 70 equal multiplied by 0.75 equal plus 1 equal multiplied by 1.8. What you get? Give it to me. What do you have there?
2.39.
2.39. Okay.
Sorry, 38.
2.39.
38, sir.
2.38.
Okay, 2.38. Then now this is the gear beta of Telemundo. I will then move to step 4. Step 4 is to calculate cost of equity using capital asset pricing model. This is step 3. Then step 4 is to calculate cost of equity using capping. All right. So here is step 3. So to calculate cost of equity using capping, it will be risk-free rate of return plus beta multiplied by market return minus risk-free rate of return. Okay.
It should
So
be
I would then
step
say
4,
cost
sir.
of step 4. Yeah. Thank you. So I would then say cost of equity equal. I will go back to the question. What's the risk-free rate of return given to us? So according to the question, we are told that when you look at this paragraph, you are told that the asset beta of the company is 1.2. Equity beta is 1.6. The risk-free rate is 5%, while the market risk premium is 7. So risk-free rate of return is 5%. Here is 5 plus the beta we have calculated in step 3, that's 2.38. Multiplied by, we are not given market return in the question, we are given risk premium. Risk premium is 7%. So there's no need for you to say R minus F again, R minus RF. So the difference between market return and then risk-free rate of return is what is called risk premium. So and we are given risk premium to be 7%. So 2.38 multiplied by 7 equal plus 5 equal. Give it to me. What you get?
21.66.
21.66%.
66.
Okay. Then finally, I will then estimate WACC. Step number 5, I will calculate project-specific WACC. Step number 5. So to calculate WACC, we are going to pick equity. We have done this before. So equity value over equity plus debt multiplied by cost of equity plus debt value over equity plus debt multiplied by after-tax cost of debt. All right. So that's that. Let me just copy this. Okay. So according to the question, we are told that the debt equity proportion of Telemundo is 30%. Debt is 30%. That means equity is 70%. 70% is the same thing as 0.70 multiplied by cost of equity. We calculated cost of equity of 21.66%. That is for the left. All right. Plus the one on the right-hand side. Okay. The market value, the debt value for Telemundo is 30%. So 0.30 multiplied by, I need cost of debt. What's the interest rate of the debt? So I will then go to the question and identify the interest rate given to us. That's the coupon rate. So let's go to the question and identify that. When you look at this paragraph after the table, examiner told you that fixed overhead cost will be 50 million at current prices, but will rise by 8% per annum. That's not what I'm looking for. This is it here. 50% of the total initial outlay of 2 billion is to be funded with a loan from a federal government development bank at a conventional fixed interest rate of 8%. So we have interest rate of 8%. That's your cost of debt. That's cost of borrowing, KD. So 8% is the cost of debt. So multiply by 8%, multiply by 1 minus tax. 1 minus tax is 0.75. So give me from the left, please. What do you have?
15.162.
15.162. So
Yeah.
15.16, 2 decimal points. Then plus the one on the right, 0.3 multiplied by 8 multiplied by 0.75. What you get?
0.018.
0.1.
Start. No.
Did you say?
Okay. No.
0.018.
It's 1.8.
1.8.
Why
1.8.
are you confusing yourself? I've told you severally. Ignore the percentage. Hello. I've told you in several. We have calculations on this basis. We did traditional work. We did project specific work. We did Wakoka. I've told you don't always ignore the percentage. Why are you still using percentage? You are confusing yourself. 0.3 multiplied by 8 multiplied by 0.75. Don't include percentage.
1.8.
1.8%. So add it up. So our work would then be equal to
16.96.
16.96%. That's our work. Examiner says you should round your number to whole number. You should round your final answer to whole number. So our work is approximately 17%. Okay, our work is approximately 17%. So this is what the examiner wants you to do. If you are the one solving this question, it shouldn't take you more than 10 minutes maximum. It shouldn't take you more than 10, but here we are. We have spent over an hour to be calculating this because I have to explain. Okay, so please ensure you practice. So 12 marks out of 100%. I've pocketed 12 marks. Let me move to the next one. I'm looking for 88 marks. Yes. So examiner is, see, you cannot earn your 12 marks. So there's no way you are going to earn your 12. These 12 marks, you cannot earn it. If you don't state your assumption, examiner says, number one, you should round your final figure to whole number. Then number two, you have to state your assumption. What are the assumptions you have made in your calculation? So let's briefly state the assumptions. Okay. Assumptions. The calculation above. The calculation above is based on the following underlying assumptions. What assumptions have we made in our calculation? That's what the examiner is asking you to state. So I can say assumption. All right. I don't need both. So what assumption have we made in the question? Because of time, the first assumption is that, let's talk about business risk. Remember what I told you when I was giving you the note under project specific, that it is assumed that both the main company and the proxy company have similar business risk. So our assumption is that the two of them has similar business risk. That's why you are borrowing the beta of a proxy company. So it is assumed that both the proxy company and Telemundo PLC have similar business risk. Of course, in practice, no company can have the same business risk. It will always be different, but in theory, that's what it is. Okay. That's one assumption. The second assumption is, so let's talk about gearing ratio now, or debt equity proportion. Gearing ratio. All right, you need to comment on this. Number two. The debt equity, the gearing ratio, or let me put it this way, debt equity ratio. Debt equity ratio of 40 to 60 or 40 to 60 is assumed for the proxy company, while 30 to 70 is assumed for Telemundo. So the examiner understand my perspective. Okay. What else? What other assumptions have we made? In the question, you are not given debt beta for Telemundo. So you need to comment on that. Debt beta. That's number 3. Debt beta of Telemundo is not given. Therefore, it is assumed to be risk-free. So that's okay. So any other assumption that you have made, you can comment on it, but this is okay. You don't have time on the day of your exam to be writing too much stories. Next, so that's end of the question. End of the requirement number A, 12 marks. I will then move to requirement number B. Requirement number B, you have 2 things to do. You have to compute net present value and then modified internal rate of return. How many marks is awarded for this? This is for 16 marks. Therefore, I want to calculate net present value. So I will come here, calculating net present value, NPV. I will go back to the question and check. The figures given to us, are they in thousand, in millions, or just absolute value? All right. We are given figures in billions, okay? So we can use millions for our for the purpose of our calculation. Let's restrict our numbers to millions. All right. So that will make our job faster. So our figures will be restricted to millions. Okay. So this is requirement number B. Yes, Tosin, what's your question? Quickly.
All right, sir. Good morning, sir. I think the requirement A still have one part. It says, and state why you consider the rate more appropriate than the existing work of 11%.
Yes, you are correct. You know, we have calculated our work. Our work is 70%. So you can just comment on that. You then say the work from the requirements, you are to, let me check. You have to compose blah, 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 appropriate cost of capital and state why you consider this rate more appropriate than the existing work. Okay. So I will then come here. I will say the appropriate work. The appropriate work that Telemundo should use for the evaluation or appraisal for the evaluation of cement projects is approximately 17%. Okay. This is the current work. Let me put it this way. The current work of 11%. Is it 11%? I think so. Let me write it down first. The current work of 11% is not suitable. It's not suitable to appraise the cement projects, since it's not suitable to appraise cement projects since the existing work does not incorporate the systematic let me reword it. The current work of 11% is not suitable to appraise the cement projects because because the existing work, or I've already said current work, because it does not incorporate the systematic business and financial risk of cement production or cement industry or cement projects. Okay, that is why the existing work of 11% is not suitable. All right, so examiner say you should calculate appropriate cost of capital. You have done that. You also asked to comment why the existing work of 11% is not suitable. We cannot use this 11% to evaluate cement projects because the 11% work does not incorporate, all right, the risk associated with the with cement production. So that's why we can't use the 11%. So that is that. So number B, requirements. We want to calculate NPV. All right. So let me call it number B1. Only one question since. See life. Requirement number B1. Of course, if you are the one solving this on the day of your exam, you are not expected to, by now you would have moved to question number 3. I trust you. Now, I want to create my table for calculating NPV. Remember, you have a format for calculating NPV. And I said that when you have multiple variables in a question, you are given sales value, right? You have variable cost, you have incremental fixed cost or specific fixed cost, you have working capital, you have scrap value, you are given initial outlay, you have working capital, you have inflation, there's also taxation. In this case, you cannot use the small table to calculate NPV. You have to use the columnar format. Okay, for those of you in Isolo, I've not given you the columnar format, but here it is. I'll be explaining what you need to do. Now, I will then go back to the question and identify how many years, what's the useful life of these projects? Okay, according to the question, the useful life is 5 years. All right, the useful life is 5 years. Not only that, I will also go back to the question and check, when am I supposed to pay my tax? Examiner told you that tax rate is 25% for the two companies and it's paid in the year profit is made. Therefore, there is no 1 year lag. So I will then come here, I will create column for 5 years to calculate my NPV. Okay, let me create a table for this. Description, year 0, year 1, year 2, year 3, year 4, year 5. Then I will have additional column for workings. Okay. So this will be for year 0, year 1, year 2, year 3, year 4, year 5. I need additional column. Additional column for workings. All right. So this is the format you are going to use. This is the columnar format you are expected to use anytime you want to calculate NPV, where you have multiple variables. All right. So this is the format you are expected to use. It will make life easy for you. All right. So what am I supposed to do here? I will then go to the question from the format. The first item is sales value. Before I write it down, I need to go back to the question and check what is the sales. Am I given selling price? If I'm given selling price, I'll also check if I'm given inflation rates. All right. Now, for the purpose of the solo student that I've not explained inflation for, Now, when you are evaluating a project, you are supposed to, if you are given inflation rates, you need to incorporate inflation into your cash flow. So we have two types of inflation, general inflation and also specific inflation. But the bottom line is that for the purpose of project evaluation, there are two types of cash flow, right? We have money cash flow. We also have real cash flow. The money cash flow is the cash flow that incorporates the possible effect of inflation. That is, the money cash flow is an inflated cash flow. So if in a question you are not told whether it is money cash flow or real cash flow, you are going to assume it is money cash flow. Now, we also have real cash flow. Real cash flow are cash flow that do not include the possible effect of inflation. They are cash flow stated in today's prices, year zero prices, current value times, okay, or first year prices. So when you are told in a question that cash flows is stated in today's prices or current value times, you should know that it is real cash flow. So if you are given a real cash flow, it means that examiner you want you to do, you have to convert it to money cash flow. All right, I will show you as we begin to solve. I will be demonstrating how to convert real cash flow to money cash flow. Now, not only that, there is a general, before we talk about general rules, we also have money cost of capital and then real cost of capital. Money cost of capital, also known as money discount rates or nominal discount rates. It represents the cost of capital that include the possible effect of inflation. All right. Inflated cost of capital is known as money cost of capital. The second one is real cost of capital. And I said real cost of capital is the cost of capital that does not include the possible effect of inflation. It is a discount rate that is stated in real terms. All right. So to calculate money cost of capital or real cost of capital, you are expected to use Professor Ivan Fisher effect formula to get your money or real cost of capital. However, there are general rules you are supposed to apply when you want to incorporate inflation in capital budgeting. The first rule is that money cost of capital must be used for money cash flow. Rule number 2, real cost of capital must be used for real cash flow. Rule number 3, do not use real cost of capital for money cash flow. Rule number 4, do not use money cost of capital for real cash flow. More importantly, when cash flows are stated in year 1 prices or first year prices, inflation should start from year 2. That is, it should start inflating from year 2. Once you are given first year price, you need to start inflating from year 2. You don't inflate the first year price because the first year price is the base year price. It is the price you are going to use to project for the future cash flows. Number 2, when cash flow are stated in today's prices, year 0 prices, or current value times, inflation should start from year 1. That is what you need to do. Now, back to the question. When you look at this question, I want to calculate sales value. To get my sales value, I will need selling price. I will then check from the question, this selling price, do you have any inflation? If there's inflation, I will inflate the selling price before I calculate my sales. Now, from this paragraph, we are told that a bag of cement sells currently for 2,000 naira. Examiner has mentioned currently. That means this selling price is in current value terms. The selling price is in current value terms. The selling price of 2,000 naira is in current value terms. So inflation must start from year one because this is real cash flow. This is real cash flow and it is stated in current value terms. Therefore, I have to start inflating from year one. Again, I need to identify whether there is inflation associated with the selling price. You are told that this price is expected to increase at the rate of 5% per annum. Therefore, I'm going to calculate my sales. All right. I will come here, sales value. I want to calculate sales. I need to go and do my working for sales. Okay, let me start my working from here. Workings. Working number one. I want to calculate sales. Okay, how do I get my sales? Let me copy this. 5 years. Let me bold this. All right. So I have for year one, year two, year three, year four, year five. I don't need, this is 6. Let me remove that. That. Column. Yeah. So I will then come here. Selling price. According to the question, we are given a selling price of 2,000 naira. We are told that a bag of cement sells currently for 2,000 naira. Because examiner has mentioned currently, it means that the 2,000 naira is in current value terms. So if it is in current value terms, then I need to multiply with the inflation. I have to start inflating from year one. Therefore, inflation rate for selling price is 5%. Okay? Let me expand this. Therefore, I will then go to the question. I have 2,000. 2,000 multiplied by 1.05. Okay? Let me look for one of you to be giving me numbers. Oh, help me. Who are those people that have been making noise before? Anyway, who is helping me who will be giving me numbers? Promise.
Yes, sir.
Promise. So be giving me the numbers. Bring out your calculator. 1.05. Now pay attention. This is what we are trying to do. We want to, this selling price of 2,000 naira is in current value terms. So which means that I have to start inflating from year one. So to do this, to inflate, you are going to multiply the real cash flow. You multiply real cash flow with 1 plus inflation rates. 1 plus inflation rate. Inflation rate is 5%. 1 plus 5% will give you 1.05. Therefore, 1.05 multiplied by 2,000. What do you get? Promise.
Yes, sir.
What's your answer?
2,100.
2-1.
2,100.
You have to move faster. You have to move faster. 2,100. So 2,100 multiplied by 1.05.
2.205.
2205.
2205. I'm not sure Promise has eaten this morning. He's struggling. All right. 2205 multiplied by 1.05.
2315.25.
2315.
15.
Please, we are using the number. Hold on. This is what you are supposed to do. You are using the answer you have in your calculator to multiply with 1.05. You continue like that until the final one. Okay. So don't round it. Year 4, what do you have?
2431. 2431.
2431. Year 5.
2552.
Yes, 2553.
Okay. Let me confirm.
Yeah. 2554.
Uh-huh. So I've gotten three different form answer now. Let me just check myself.
It's
2,000
3. Oh, sorry, sorry, 3.
multiple. That's
Sorry,
okay.
sorry, you
1
not
point.
round up. Okay, it's 2.1.
Don't worry, confirm
The dot
myself.
is points. Okay.
2,000 multiply by 1.05. That's 21. Then multiply by 1.05. That's 2205. That's correct. Then multiply by 1.05. That's 2315. That's correct. What I have in my calculator, multiply by 1.05. That's 2431. Let me check. Is it 2431 correct? Then the final one, multiply by 1.05. That's 2553. You are correct. That's it. So this represents my inflated selling price. I will then multiply this one with the number of units. Units. What's the unit sold in year one?
500.
500,000. Units sold in year two?
600.
600,000. Units sold in year three?
650,000.
Year four?
800,000.
Year five?
700,000.
Thank you. So this represents the total. This is the number of units sold. So I will then get my total sales. So sales will then be equal to selling price multiplied by the units sold. Or let me do it this way to make life easy for everyone. Units. Let me copy this. So I don't need to be repeating it again. Okay. All right. So in this case, I'll just say says. Let's call this one. Let's make this one to be B. B. This is B. Let me reduce this once. Don't waste my time. All right. So sales will then be equal to A multiplied by B. The units is the A. All right. So 500,000 multiplied by 2,100. What do you have?
Is it in Naira or millions, sir?
Our figures are in millions.
That's 1,050 Naira.
1050.
1,050.
Okay, our figures are in millions. Okay, so here will then be equal to 1,050. Year two, 600,000 multiplied by 2,205 equal, round your number to millions.
13,000.
Pardon?
13,230.
It can't be 13,000 now.
1,323.
1,000 what?
323.
323. Okay. Then year three, what do you have in year three?
1,505.
Your voice is not clear.
1,504.
504. Year four.
0.75.
0.75. So 1505. Thank you.
Okay.
Year 4.
1,945.
44.
194445.
45. Yes.
45.
Year
Are you rounding up?
5. You have to round the final number now.
Okay.
1,767.
787.
787.
787.
787. So this represents the total sales. Then I need to go and this is the inflated sales. So I need to go and post. I will then come here. All right. Let me remove bold. So that's the answers for my sales value. Ayomide, what's your question? Quickly. Ayomide, what's your question? You raise hand. Okay, you are not ready. So let's move back to the question. Let's go and check if we are given variable costs. Are we given variable costs? From the same paragraph where you pick the selling price, you are told that variable cost is now 800 naira per bag. Now simply means year zero. Or examiner can tell you that selling price now, or sorry, variable cost now, or today, or immediately. Once they use the same language, it's the same thing. If you are told now, it means year zero. If you are told now, it means today. If you are told now, it means immediately. So if examiner does not use now, they can use today, today's price. They can use immediate price. They can use year zero price. So it is real cash flow. So this variable cost of 800 naira is real cash flow. And because it is stated in today's price, inflation must start from year 1. So what's the inflation rate for the selling price? We are told that it will increase by 4% per annum. 800 naira will increase by 4% per annum. So I will do the same thing I did for sales. Let me copy this. This is working number 1. Then working number 2, variable cost. All right. So according to the question, we are given a variable cost of 800 naira. Now, variable cost, VC. So we are given a variable cost of 800 naira. Now, 800. So inflation rate is 4%. Therefore, 1.04 multiplied by 800. What do you have?
832.
832.
832.
832. Let me remove all of this. 832 multiplied by 1.04.
865.
865 multiplied by 1.04.
899.
900.
899.
900.
900.
So what you have in the calculator multiplied by 1.04.
936.
936.
The final year.
973.
973.
973. All right. So you then multiply with number of units produced. A multiplied by C. Number of 600, sorry, 500,000 multiplied by 832. What you get?
416.
416. Next one.
519.
519. Year 3.
It's 585.
585. Here 4.
749.
No.
Then here 5.
681.
681. All right, so that represents our total variable cost. Total variable cost, BC. All right, so I will then go and post this. With this, I've incorporated inflation in the variable cost. Let me remove the board. All right, so variable cost is a cash outflow. You put it in brackets. Okay. This is for working number 2. There is working number 2, variable cost. Next, I will go back to the question and identify any other relevant cash flow. After variable costs, I want to check if I have any incremental, attributable, or specific fixed costs. In the same paragraph, we are told that fixed overhead costs will be 50 million naira at the current prices, but will rise by 8% per annum. So this is a future cash flow. Fixed overhead. The company will incur fixed overhead of 50 million naira. That is relevant. And we are told that it will increase by 8% per annum. Okay. So I don't need to do working for my fixed cost because it doesn't involve any activity level. So I will come here fixed overhead. Fixed overhead, or just say fixed cost. Because of space, let me reduce it. Fixed overhead. The fixed overhead in the question is 50 million, all right? And we are told that it's in current value terms. Therefore, 50 million multiplied by 1.05, okay? Multiplied by 1.05. So what do you have? 50 multiplied by 1.0. 52.5 at, is it 5? Sorry, it's at 8%.
Thanks.
It's at 8%. Do it again.
54.
54.
54. 54 multiplied by 1.08.
58.
58 multiplied by 1.04.
63.
Multiplied by 1.04.
68.
Multiplied by 1.04.
73.
73.
73. That's it. I've inflated the fixed overhead. All right. So let's move on. Let's go back to the question and identify if we have any other relevant cash flow. Still on the same paragraph. All right. We are now told that apportioned head charges of 25 million naira at current prices will rise by 10%. This is an apportionment. Any apportionment is irrelevant cost. You have to ignore it. Okay. Apportionment is not a relevant cash flow. So that 25 million naira is irrelevant. All right. You're also told that, what other information do I have here? We are given working capital. We are coming to that. We also have other cash flows in the second paragraph of the question. Okay. We are told that the sum of 2 billion naira will be required. The sum of 500 million will be spent to acquire an existing factory considered suitable for the project. The balance of 1.5 million naira will be applied for the procurement and installation of essential plant and equipment. Tax allowance can be claimed on plant and equipment at a uniform amount over 5 years with new scrap value. That's just talking about the initial outlay. We're coming for that. Then next paragraph, a total of 20 million naira has been spent on various surveys, market, technical, and financial survey. To date, out of which 10 million naira has been paid. The balance of 10 million naira is due for payment at the end of year 1. Okay? Don't let the examiner confuse you. When I was explaining the concept of relevant cash flow, we talked about historical cost. We said historical cost is also known as sunk cost. They represent the costs that have already been incurred. All right, this 20 million naira has already been incurred, irrespective of when the payment will be made. You are told in the question, because examiner is trying to test your understanding, you are told that out of the 20 million, 10 million has been paid. The balance of 10 million is due to be paid. An average student would think that, okay, since only 10 million has been paid, that means the balance of 10 million is relevant. When you do that, you are going to get it wrong, because examiner told you that a total of 20 million naira has been spent on survey. Survey, all this activity has been completed before the project begins, because cash flow, relevant cash flow must relate to the future, not the cost, not the cash flow that have been incurred. It has to be cash flow that has not been incurred at all. So this 20 million naira has been spent on market survey, technical survey, financial survey. Therefore, it is not relevant. Irrespective of when the payment will be made, it is a sunk cost and therefore not relevant to the calculation. You are supposed to ignore it. Okay? That's no other cash flow again. So at this point, I need to determine my profits. So let's determine the profits, add everything together for each year. What do you have here? Yes, somebody raised hand the other time. Wikos, what's your question? You raised hand the other time. Okay, so.
For the first year, 580.
Yep. 580, 580. Year 2.
746.
746.
746.
Year 3, 857.
857. Year 4.
Last year, 1033.
1033.
Year 4,
4.
1128.
1128.
128, yeah.
Okay then. So this represents the profits. Immediately after profit, you are supposed to pay tax. All right, so let's go and calculate tax. I will then come here. I'm using tax saved on capital allowance to reduce my tax liability. So I will then multiply company tax rate. Company tax rate is 25%. Therefore, I will multiply 25% on the taxable profits. So what do you have? What's 25% of 580? Pardon?
145. 145.
145. You have to be very careful. First thing first, you go back to the question to go and check. When are you supposed to pay the tax? Are you paying it in the current year that the profit is earned, or you are paying tax 1 year in arrears? So examiner told you that tax is paid in the year profit is earned. Therefore, there is no 1 year lag. So you say it's 45, 145.
145, yes, sir.
Then year 2, 25% of 746. What do you get?
187.
187. Next.
214.
214. Next.
282. 282.
282. And the final year.
258.
258. So that's the tax liability that the company will pay on the project. Then we need to go and calculate tax saved. Tax saved on capital allowance. So that will take us to working number 3. This is working number 2. Get out. All right, so working number 3. Tax saved on capital allowance. Okay. How do you calculate tax saved on capital allowance? That's a format you are supposed to use to do this. Let me use this table. 1, 2, 3. That's okay. No, 4. Okay. Now, like I explained to you last time, the essence of capital allowance is to reduce taxable profit and in effect, tax liability. You are calculating capital allowance in order to reduce tax liability. So I can either use capital allowance to reduce my tax liability, or I use tax saved on capital allowance to reduce the tax liability. Whichever one I use, I will get the same answer. But like I mentioned, at all time, always use tax saved on capital allowance because it's there in the format you are using for the calculation of your NPV. Therefore, the first item here will be number of years. Indicate column for year. Description of item, or you call it narration. Okay, here is narration. Then the cost of the assets. The cost of the asset will be here. Then we are going to have tax saved. We are going to have tax saved on capital allowance. The third column is not needed. So I need to go back to the question and check, how am I going to claim my capital allowance? Okay, according to the question, where do you have information on capital allowance? Yes. According to the question, we are told that 2 billion naira will be required for this project. 2 billion naira will be required for this project. Out of the 2 billion, 500 million naira will be spent to acquire existing factory considered suitable for the project. You cannot claim capital allowance on second-hand assets because it is believed that the original owner of this factory, and you cannot transfer capital allowance. Okay, therefore, the 500 million does not qualify. The 500 million for the existing factory does not qualify for capital allowance. We ignore that. Then you are now told that the balance of 1.5 billion will be applied for the procurement and installation of essential plant and equipment. Yes, that's the qualified capital expenditure. To confirm that, examiner is now telling you that tax allowance can be claimed on plant and equipment at a uniform amount over 5 years. Okay, so examiner has told you that it is on plant and equipment. So our capital allowance is on plant and equipment. So I don't need to waste too much time on this. And we are told it's on a straight line basis. Therefore, I will then come here, working number 3. So my capital allowance. My capital allowance, according to the question, I don't need to be doing too much working on this. Capital, let me put it like this. Capital allowances is on a straight line basis. I don't need to waste my time. Capital allowance is calculated as the cost of the projects. What's wrong with you? Cost of the projects multiplied by capital allowance rates. All right, multiplied by capital allowance rates. Capital allowance rates. Okay. Therefore, capital allowance will then be equal to the cost of the project is 1.5 billion All right, that's the cost of the project. 1.5 billion. All right, then multiply by the capital allowance rates. I will go back to the question. What's the capital allowance rate given to us? What's the capital allowance rates? Yes, we are told it's on a straight line basis. We are not given the rates. So since it's on a straight line basis, all right, we are told a uniform amount over 5 years. So I will just divide 1.5 by 5 years. So that will give me the capital allowance, annual capital allowance. Okay, so here divided by, let me copy this. Let me copy just this one. Okay, so because in the question, the examiner told us that it's on a straight line basis. Okay, let me just give you, let me change my, since capital allowance is a uniform amount or is on a straight line depreciation, that is uniform amounts. Okay, the capital allowance will be calculated or is determined. The capital allowance is determined. I don't need to use table again, so I will cancel that table. Is determined by dividing the cost of the projects, the cost of the plant and equipment, with the useful life of the assets. All right, so that's how we are going to get our capital allowance. All right, so in this case, capital allowance will be equal to 1,500 divided by the useful life of 5 years. 5 years. So that will give us 300 billion for each year. All right. So 300 million for each year. Okay, so that represents our capital allowance. So now that I have capital allowance, I need to calculate tax saved. Tax saved on capital allowance, which is calculated as capital allowance multiplied by company tax rates. All right. So tax saved, let me just copy. Similarly, what's your question? Capital allowance is 300 million. What's your question, Similarly?
Okay, sir. I wanted to say that we can still maintain the rate if we choose to, going by using this formula, which will just be equal to 0.2. That's 20%. Yes, sir.
Yes, you can do that. Yeah. Okay, so tax saved on capital allowance multiplied by company tax rate of 25%. Give it to me. What do you have?
7.5 billion.
7.5. 7.5 or 75?
75.
Okay. So 75 million is tax saved on capital allowance. So that is what we are going to use. So I will then come here I don't need this table. I don't need this table. Let me just delete it. Okay, since capital allowance, all right. So 75 million. I will then come here, tax saved on capital allowance, working number 3. Each year is 75. So you are using it to reduce your tax liability. All right. 75. And then tax saved on capital allowance must follow the patterns of your tax liability, meaning that if your tax liability is in the current year, your tax saved on capital allowance must also be in the current year. If your tax liability is in arrears, your tax saved on capital allowance must also be in arrears. All right. The next item will then be the scrap value. According to the question, we are told that there is a nil scrap value. So since there is no scrap value, so you just ignore that line item. You ignore the line item because the examiner told us that, where is that? Yes. We are told that a uniform amount over 5 years with a nil scrap value, 0 scrap value. So there is no need for you to come and say scrap value, then you put dash. Don't do that. That is primary school method. Then the next item will be initial outlay. Initial outlay. According to the question, the initial outlay is 2 billion. So here will be 2,000 negative. Okay. Next item. After initial outlay, I will go back to the question and check if I'm given working capital. That's a format. So we are following the formats. All right. So I need to go and check if I have working capital. According to the question, we are given a working capital. I think I highlighted it the other time. Yes. You are told that the project will require a working capital of 10% of annual revenue, and this should be available at the beginning of each year. So we have a working capital of 10% of annual revenue. We have calculated revenue before. Okay, let me see. And this should be available at the beginning of each year. All right, so let's go and calculate working capital. That will take us to working number 4. Let me just copy this. I'm going to need it. Working number 4. Working capital. How do I calculate my working capital? Examiner has told you that working capital is 10% on the current on the sales value. So we have calculated sales value before. This is the value of our sales. This is our sales value. Okay, so this is annual sales value, and you are now told that working capital will be, this is sales, not selling. All right, so we are told that working capital is 10% of sales value. So I will then come here, working capital at 10% of sales. Okay, so what's 10% of 1050? That will give us 105, right? 10% of 1323 will give us 132. 10% of 1505 will give us 151. 10% of 1945 will give us 195. 10% of 1787 will give us 179. Okay? So if that is the case, what's the next thing we need to do now? When you look at our working capital, you will see that our working capital is increasing from 105. It has increased to 195. Okay, working capital has increased from 105 to 195. Then in year 5, it now dropped to 175, 179. Okay, before we get to that point, we need to determine our incremental working capital. It has increased from 105 to 132 to 151 to 179. Let's determine the incremental working capital. Remember what I told you. Working capital represents the difference between current asset and current liability. Okay? How do you treat working capital? I said working capital should be treated as a cash outflow in the year before the year of occurrence and then recover fully at the end of the useful life. All right. So we have a one-off working capital. We also have incremental working capital. In this question, our working capital has increased from 105 to 195. 195 is the highest figure. Therefore, this is incremental working capital. The first thing you need to do is to determine the amount of the working capital, then you now determine the increments. So incremental working capital now. The first year working capital is 105. 105 has increased to 172, 132. What's the difference?
27.
27. 132 minus 151. What's the
19.
difference? 19.
19.
151 minus 175. What do you have?
195. 44.
44. You will notice that, okay, let's find it. What is the difference between 195 and 179?
16.
Minus 16.
Now, pay
16.
Yes, pay attention to this. Pay attention to this. The rule says that working capital should be treated as cash outflow in the year before the year of occurrence and then recover fully at the end of the useful life. We have calculated incremental working capital for each year. Now we want to go and post. I will then come here, relevant year. That is, which year am I going to account for the working capital? Now, the working capital of year 1, which is 105. All right, this 105 should be treated as cash outflow in year 0 because year before year 1 is year 0. The 27 million will be treated as cash outflow in the year before year 2, which is year 1. The 19 million will be treated as cash outflow in year 2, which is the year before year 3. The 44 million will be treated as cash outflow, all right, in year 3. All right, in year 3. Okay. Now, when you look at, pay attention to what I'm about to say. At year 4, our working capital of 195, in year 4, working capital was 195. In year 5, working capital is 179. Pay attention. When working capital is increasing and it starts falling at a particular year, it means that the company has recovered part of the working capital. So in this question, the highest working capital is 195, but in year 5, it has reduced to 179. It means that the company has recovered part of the 195. So when your working capital is increased, let me put it down for you. Note, when working capital is increasing, okay, when working capital is increasing and start falling at a particular year, It means the company has recovered part of the working capital. So that is what happened in between year 4 and year 5. Okay, so note that. So in this case, let me create additional column for total. So total here is total. All right. So the total working capital will then be equal to 195. Out of the 195, pay attention to this. We said 195 minus 179, you have 16, right? Then 179 minus 0 will give us 179. That will give us 179. This is what I'm saying. The highest working capital is 195. Okay? So when you add up 105 plus 27 plus 19 plus 44, that will give you the 195. When you add up 116 plus 179, you have the same thing as 195. So that is the recovery. So in year 4, the company has recovered working capital of 16 million. Then in year 5, the balance of 179 will be recovered. So this is what I'm going to post for year 0 up to year 5. I'll then go to my table of NPV, working capital, year 0, working capital. This is working number 4. Okay, so that's that. After working capital, you then determine your net cash flow. Net cash flow. Give it to me. What's the net cash flow for year 0? That will give us 2105. Yes. What's the working? You are taking it from profit. Profit minus the rest. So what do you have for each year? Let's be fast. Pardon?
483.
483.
Yeah.
483. Next one.
615.
615. Year 3.
674.
Pardon?
674.
674. Year 4.
937.
That's not clear.
937.
937.
One
Are you
zero
on bed?
1029.
1029. Okay. So that represents our net cash flow. With this net cash flow, you can then use any technique to appraise the project. You can use NPV, you can use internal rate of return, you can use modified internal rate of return, you can use project duration to appraise the project. So we are calculating NPV. So I then indicate discount factor. Discount factor. According to the question, examiner told you that you should assume a discount factor of what? 13%. Examiner wants you to use 13% because ordinarily I would expect examiner to ask you to use the cost of capital you compute in requirement number A to appraise the project. But because examiner is so magnanimous, the examiner is aware that there will be some students that will not get number A requirement correctly, because if you get the A wrongly, that means the answer to number 2 or to B requirement will also be wrong. And that's what the examiner is asking you to use 13%, which is good. And your final answer is to be rounded to nearest million. Okay? So we are using cost of capital of 13%. All right. So at 13%. Okay. So give it to me. What's the discount factor for year one at 13%?
0.88.
0.885.
85.
Next,
0.783.
783. Year three,
0.693.
Year four,
0.613.
0.613.
Year five,
0.543.
43.
543. So you then multiply. You multiply with the net cash flow. So that will give us present value. So what's the present value for year one?
2105.
For year one,
427.
427. Year two,
482.
482. Year three,
467.
467.
Year four,
574.
574.
year five,
558.
559.
559. So at this point, I then need to calculate my NPV. Let me create a column, just a single column to match. 3 is okay. All right. So my NPV. Don't waste my time. Okay. Let me adjust this one too. All right. So that's it. That. Scatter what I've done. What's wrong with you? I'm just trying to align my table. Oh, that's okay. No time. So our net present value.
Positive 44.
404. Present net present value. You know, we said that net present value represents the difference between present value of cash inflow and present value of cash outflow. You first of all add up the positive present value. You then net off the negative present value. So your final answer is 404 according to promise. So if that is the case, the next we need to, that's our NPV. We then need to comment. Let me bold this. Our net present value is, let me just reduce this. All right, so our net present value is 404 million naira. Let's go back to the requirements. You are to calculate net present value and modified internal rate of return. Examiner did not ask you to to advise in this number B requirement, you are only asked to calculate NPV and then modified internal rate of return. Number C is where you are supposed to recommend. Okay. Don't forget, as you are calculating this, you also need to state your assumptions. So it's not that you are just going to get 30 marks on a platter of gold. No, it doesn't work like that. You have to sweat for it, you know. So let's come here. We want to calculate, let me copy this. We want to calculate modified internal rate of return, BII. Calculating modified internal rate of return. All right, MIRR. Okay. How do you calculate modified internal rate of return? We said that modified internal rate of return can be calculated using either terminal value method or present value method. And I told you specifically that the present value method should be used if you have calculated NPV before, or if NPV is given to you and you are asked to calculate modified internal rate of return, then the best method to calculate modified internal rate of return will then be the present value method. So let me go and copy the formula I have before for calculating modified internal rate of return. Okay, let me just copy it. So I don't need to be struggling for formula, looking for where formula is hidden. Where are you? Modified internal rate of return. Almost there. This is project duration. Yes, this is the formula. So this is the formula we are going to use. See, I've told you all of this. I've explained all of this before. Look at my comment here. This method is the most suitable where NPV has already been calculated or given. The steps below can be carried out when calculating modified internal rate of return. So we have done this before. So now it's for us to apply it. Where am I? Sorry. We can't solve more than this question today. Next class, we solve another one. So because I'm explaining, that's why it's taking time. Where am I? Okay, this is working. Yeah, this
You
is
really
it.
tried, sir. Thank you very much.
You're welcome. So I would then say, since net present value has already, on the day of your exam, there is no need for you to be saying all of this. Just put down your formula and move on. But because of your own understanding, so let me just put a comment. Since NPV has already been calculated, okay, comma, the formula below will be used to estimate the modified internal rate of return. Okay, this is the formula will be used to estimate. All right, so this is the formula, the bid for nothing formula. All right, so like I said, this formula will always be given to you at the back of your answer book, at the back of your question paper. All right, it is written as present value of return phase. Like I said, there are two phases of projects. We have the investment phase. We also have the return phase. When the company is spending money on the project, that's cash outflow. That's the investment phase. When the project starts generating revenue, start generating inflows, that is the return phase. So cash inflow is the same thing as return phase. Then cash outflow is the same thing as investment phase. Okay, so cash inflow, to calculate modified internal rate of return, it is present value of cash inflow over present value of cash outflow raised to power 1 over n. N is the useful life of the project, all multiplied by 1 plus company's cost of capital, or minus 1. So whatever you have thereafter will give you the modified internal rate of return. So we have calculated present value before. When we calculated the NPV, we added up all the positive present value. That's your present value of cash inflow. We minus 2104 and we got the NPV of 404. Therefore, for me to now get my present value back, I will just say 2105 plus 404. That will give us 2509. So of cash inflow is calculated as 2509 divided by present value of cash outflow. We calculated 2105. Okay. The useful life of this project is 5 years. So 1 divided by 5. 1 plus cost of capital. Cost of capital is 13%. That's 1 plus 1. That's 1.13. You can see it's not difficult. You see how life is so easy. So what's your final answer? 2509 divided by 2105 equal raised to power. Okay, let me do additional one. Let me just copy this. So 1 divided by 5 will give us 0.2. All right. Therefore, what's your final answer? 2509 divided by 2105 equal raised to power 0.2 equal multiply by 1.13 equal minus 1 equal multiply by 100%. What do you get?
17%.
17%. So the modified internal rate of return is 17%. This is how to calculate modified internal rate of return. You can see, very easy and straightforward, right? But when I was explaining this, I spent almost 45 minutes or thereabout to be doing the explanation. Meanwhile, the calculation is now up to 5 minutes to solve. Okay, that is only if you know it. No matter how simple is a question, if you don't know, you don't know. There's nothing you can do about it. All right, so that's that. Next item. Now, you cannot earn the entire 16 marks if you don't state your assumptions. Okay, in the question, in number B requirements, examiner is asking you, right? You are asked to compute NPV and then modified internal rate of return. So you can see here, the examiner did not tell you to state your assumptions. So you can never earn the entire 16 marks if you don't state your assumptions, because there are some cash flow in the question whereby you ignore them. Why did you ignore? You have to state your assumption. Yes, Zoom user, quickly, what's your question? Zoom user, you raise hand. What's your question?
Okay, can you hear me?
Yes, go ahead.
Okay. What we got there for modified internal rate of return is 17%. And if you look back to what I just want to know if there's any relationship between the two, which is
No,
a specific.
It's just coincidental.
Okay.
It's just coincidence. Yeah. Yeah. Okay. Okay. So, like I said, you have to state the assumption always, whether examiner asks you or not. You have to state your assumption. I would then say the calculation of the net present value and modified internal rate of return above is based on the following assumption. What are the assumptions we have made in our calculation? Anytime you want to state your assumption under capital budgeting, there are some given assumptions. No matter how big is the question, you have to comment on them. The first one is cash flow. we have used cash flow. Okay? So what is your assumption on cash flow? It is assumed, this is what you are going to say, it is assumed that the cash flow estimates are realistic and will occur at the end of each year. So that's our assumption for cash flow. You can then, if you like, we can go further by saying that all relevant cash flows have been inflated at the appropriate inflation rates. That's it. You are telling the examiner how you have arrived at your figures. The cash flow given to you, only see, what you are saying here is that you select only the relevant cash flows, and then all the relevant cash flows have been inflated using the appropriate, using the specific inflation rates given to you. The second assumption you are going to make, if in the question you are given inflation rates, you comment on inflation. If you are given taxation, you comment on the tax rates. If you have any other assumption in the question, you comment on them. So secondly, we talk about inflation. Okay. What do you mean by inflation? It is assumed that the inflation rates, it is assumed that inflation will remain constant. Inflation will remain constant within the relevant range. Will remain constant within the relevant range or within the period under consideration. You are given 5% inflation rate for selling price. You are given 4% inflation rate for variable cost. You are given 8% inflation rate for fixed cost, right? So that means those are specific inflation. Okay, so our assumption now is that those inflation rates of 5%, 4%, and 8% will remain constant. It will not change throughout the period of this project. Okay, so that's what we are trying to say here. Number three assumption. Okay, assumption number 3. In the question, we also have, let's go back to, because assumption is not something you are going to fabricate. Ayomide, what's your question? You'll be raising hands since and you don't talk.
Yes, sir. So you were saying about the first one, saying the cash flow is realistic. I mean, so when you say realistic, is because most of them were mentioned, were given at their current year, right? That's what you mean by realistic.
No, that's not what it means. You know, all these cash flow, they are just estimates. It's not the actual.
All right.
Because all the cash flow you are seeing there, they are projection, they are estimates. So it is assumed that what you have projected to spend is what you are going to is the actual amount you are going to spend.
All right.
So that's why we are saying that it is realistic. That's what we mean by realistic. Okay.
I thought the realistic came from when you said real cash flow.
That's a different thing.
All right.
That's a different. So what we are saying here is that your cash flow is realistic. That is, you are making all these cash flow are just an estimate. So by the time you begin to spend the cost, you spend the money, yes, it will be the same amount. It will not change. So that's what we mean by realistic. Okay.
All right. Thank you very much.
You're welcome. Now, in the question, before we come to all those irrelevant cash flows, in the question, we're also given interest. All right. We are given federal government developments at a
Come and eat.
concessional interest rate of 8%. Okay, so let's comment on that. If you like, you can comment. Because of time,
Tell
it's
you that
almost
I really did not even know, sir. I've already gone and bought food.
well done. Oh, well done. Is that Nicole or Jessica? You are the one that is buying food. Please remember me here. I've not eaten since, so because of you, you did not allow me to eat. So send my own food to me, oh, since you want to go and buy food. All right, then let's move on. Okay. Yes. Because of time, let's just comment on the. Let's go back and pick. There are some cash flow that we ignored in the question. All this survey, okay, the surveys of 20 million, we said it is not relevant. We ignore it. So let's comment on it. Number 4 now. Surveys. So you can say the cost incurred or
You're in
the
the wrong
amount
place, sir.
spent. Pardon?
You are in the
Oh,
wrong place.
thank you. That's true. Thank you. Yes. Survey. I will then say the amount spent. The amount spent. Or the 20,000. Let me put it this way: the 20 million. The 20 million naira spent on markets, market technical and financial surveys. Financial surveys are sunk costs and therefore not relevant to the calculation. Okay, so we ignore the 20 million naira because we said it's a sunk cost. The money has already been spent. Therefore, it is not relevant. If we state like 5 assumptions, that's okay. Number next, in the question, we have what other assumption did we make? We're also given apportioned head office charges, right? Where is that? Yes, we have apportioned head office charges of 25 million naira, and we said it is not relevant because it's an apportionment. Okay, so I will then come here, head office charges. Number 4, head office charges. The head charges, the head office charges, or you can just say this is an apportionment, or you can say the head office charges. The head office charges of 25 million naira is an apportionment and therefore not relevant to the calculation. All right, so that's why we ignore it. Apportion. Okay, so that is for that. Which other ones? There are many of them. Okay, we have given 3 assumptions before. Let's see if we can add one more. Okay. What else?
Loan and interest. Interest on loan.
Yes, we can also talk about interest on loan. All right. We can talk about interest on loan. 50% of the initial 2 billion, 50% of billion, that will be 1 billion naira. So yeah, so we can talk about that. Which other ones again? I think that's okay. Because of time, it's almost time. You also have FBR, SBR. I need time for now. Okay, so let me add one more. Interest on loan or loan and interest. Let me just say interest on loan or, okay, let me leave it as that. The 50% or the federal government's concessional let me go and copy from there. Let me even see the way it is written, the way the comment goes. Where is the 50%? Yes, you are told that 50% of the initial outlay of 2 billion naira is to be funded with a loan from the Federal Government Development Bank at a concessional fixed interest rate of 8%. So let me copy this. So I would then say, let me put this one down and see. Okay. The federal government, no, that's not what I would say. I would say the 50%, let me pick it from there. The 50%, I don't need all of this story. The 50% of the total initial outlay of 2 billion naira to be funded, all right, to be funded with a loan from the Federal Government Development Bank is irrelevant. To the calculation, and therefore ignored. We don't need it. All right. So that is our assumption on that, because the cost of capital of 20%, which we have used to appraise the projects, already included interest. And that is why the 1 billion naira, the loan of 1 billion naira is ignored in our calculation. So this is okay. If you state like 3 or 5 assumptions, you are good to go. At this point, at this moment, you can earn your full mark. Finally, number C requirements, you are to recommend. Okay, you are to recommend whether the project should be accepted or not using both NPV and modified internal rate of return. So that's it. You can see this is a very big question. If you are going to have capital budgeting question on that day as a compulsory, this is how it's usually designed. All right. So recommendation. This should be requirement number C. Okay. Our NPV is positive, right? That means the project is financially viable. Our modified internal rate of return is greater than the cost of capital of 13%. That means it's also financially viable. However, this is how you are going to state your recommendation. You say that the project the projects produced a positive net present value of 404 million naira and modified internal rate of return of 17% relative to the company's cost of capital, relative to the company's WACC of 13%. Therefore, the cement project is financially viable. The cement project is financially viable considering okay, there's no even need to say considering. You've already said that your NPV is positive, your modified internal rate of return is higher than the cost of capital of 13%. So you just say, therefore, the cement project is financially viable and should be undertaken. That's all. It is only when you do this, you'll be able to earn your entire 30 marks. Out of 100%, you have pocketed 30%. You are looking for 20% to cross over. All right. So that's what this is what you are going to do. Let me know if you have any question for me so that I can release you. Nico, don't worry. All right. So any question for me so that I can release you? In our next class, we are going to solve 2 additional big questions. Hopefully, in our next class, I have to be very strategic. Okay, I have to be very strategic so that we can finish it on that day. If not, whenever we finish, we can push to the next class. All right. So Tosin, talk to me.
Okay, sir. I didn't get that part. The reason why we excluded the interest rate from the federal government bond to be as part of the fund.
The interest, you are told there is an interest of 50% on the 2 billion. When you multiply 50% on 2 billion, that will give 1 billion naira, right? So that is, when I was explaining relevant cash flow, when I was giving you the note, I said that interest is the specific percentage on the principal amount of the loan borrowed. So the absolute amount of interest is irrelevant. Why? Because it will amount to double dipping. In the calculation of WACC, you already use interest. When we calculated cost of equity, cost of preference share, and cost of debt, and finally, weighted average cost of capital. So when we calculated cost of debt, we use interest. Interest already included in your WACC. So if you are now considering 1 billion naira now, that means you are treating interest twice. So that's why you have to ignore interest. You don't use interest when you are appraising a project. You don't consider the absolute amount of interest. You have to ignore it. Okay? So that's what I'm trying to say here. Yeah. Yes. Felicia, what's your question?
Yes, sir. So please, are we still having class by 8:30 today?
Yes, our normal class we hold. This is a bonus class. The normal class we hold. Then also for
We have SFM by 4:30.
Pardon?
We have SFM by 4:30.
You have what? SFM. That's Mr. Ashiwaju. Mr. Ashiwaju will take you by 4:30 today. So our normal Tuesday class we hold later in the day. All right. That is for online students. For physical students, if you are available, I will invite you also by 8:30 if you are interested. If not, then we'll push you to our next class when we meet physically. All right. So any other question for me?
No, can you please scroll down to the last page for recommendation, please? Thank you, sir.
No, I will still share it. I will share the notes immediately after the class. Yes, any other question for me? Promise, what is blur?
I'm hungry,
Are we
sir.
still okay? You're hungry. Okay, what do you want me to say? Don't worry now. Can't you fast? You have to fast because of this ICANN exam.
Hello, sir.
No
Which
worries.
year is this?
Okay,
Sir?
pardon?
Which year is this question, sir?
It's a very long time ago. It's 2024. Sorry, 2014. It's
Oh, okay, okay.
2014. It's because of modified internal rate of return I have in the question. That's why I like to solve it. So I explain to show you how
It's a
to
good one.
calculate.
It's a good
Yeah,
one.
it's a very big one. Ayomide is saying holiday is not holiday. You know, what's your business with holiday? You are writing icon, you are looking for holiday. There is no peace. There is no peace for wicked man. You are writing icon exam, you want to be resting. Resting for where? When you qualify, then you can spend 24 hours sleeping, resting. You can be holidaying anywhere, you can go for vacation anywhere you want after your qualification. But for now, you don't have any
Sorry,
other
I'm even
priority
at
than to
work.
qualify.
Everything is very
Pardon?
choking. I'm at work.
Oh,
I'm not that
sorry.
wicked.
Sorry. It's
I
okay.
know now.
It's okay. It's okay. You know, this is public holiday. All right. I know some companies they don't give holiday, but again, it's what it is. Thank God the class is recorded. You can always watch it. You can rewatch it again. Thank you for making time to spare little time to join the
Sir,
class, despite the
hope
fact
there's no
that you are.
8:30. Hope there's no 8:30 class today.
So you are not listening to what I've been saying since.
And then 30
Who
class,
told
so maybe that's what I asked.
who
I
told you there is
skipped
no
to.
there is going to be we are going to have our normal class by 8:30 by the grace of God. Okay, then, in the absence of no further question, I want
I
to
have
say
a
thank you
question.
to every one of you for joining the class.
Sir,
By the grace of yes, Mr. Shuaju will take you by 4:30 today. All right. Then by 8:30, I'll be taking you our normal class on SFM. Every Tuesday we have 8:30 p.m. Okay.
sir.
All right,
Hello,
that's
sir.
this. Yes, talk to me.
Hello, sir. Sir, you use debt beta of 0.4 for the main company and the proxy company rather.
Yes, you can assume it because in the question, pay attention to this. In the question, the examiner did not give you debt beta for
Main
Telemundo.
company.
So
Yeah.
you can either two things. You have two options available to you. Is either you assume the proxy beta, the debt beta of the proxy company, or you are going to follow the fact that, okay, since I'm not given debt beta for Telemundo, that means it is risk free. The second option is that, okay, since I have debt beta for Telemundo, let me borrow the debt beta for Telemundo. So, sorry, I have debt beta for the proxy company. I will borrow it for Telemundo. So, whichever way you want to go, examiner is just state your assumption. In that case now, I will come here in my assumption. I will say assumption number 6. Okay, that was when I was calculating the cost of capital. I will then come here. Additional in the assumption number 4, I would then say this debt beta of where I put debt beta of Telemundo is not given is risk free, isn't it? So, but I will not say it is
Yes.
risk free. I will say that since debt beta of Telemundo is not given, the debt beta of the proxy company of 0.4 is assumed. Do you get? That's what I will say. But here I'm saying that it is risk-free. Since I'm not given, I assume it is risk-free. That is what I've done in this question. But if I have used the debt beta of the proxy company for Telemundo, I will come here to say that the debt beta of Telemundo is not given. Therefore, the debt beta of the proxy company of 0.4 is used to regear the beta of Telemundo. That's all you are going to do. Okay, is it clear now?
Yes, sir.
All right then. So I want to say bye-bye to every one of you. All right. Oh, okay, you have audits by 8 p.m. today. Don't worry, that is for, I think that should be for VI and Nisola. No worries. All right. So I will go ahead with the online class by 8:30. Okay. So thank you, everyone. Bye-bye.
Thanks,
So
sir.
Thank you,
I
Bye.
sir.
promise you can then go ahead, go and eat your food. Since you say
Thank
you are
you,
hungry,
We just hope Wasi will allow us to go and eat.
you can be eating. Okay, I forgot you are a bachelor. Sorry. It is well.
I'm feeling for 10:30.
Pardon?
Yeah,
What
10:30.
did you say?
Yes, I just said to 30.
Okay.
The
Oh,
next
okay
class,
then.
yeah, I'm
Let me
just telling the
release you
class.
now.
Yeah, next class, yeah.
Okay then. So go and eat now. Your SBI will start 10:30. Thank you, everyone.
Thank you, sir.
Okay, sir.
You're welcome.